The man, the myth, the legend, Fed Jerome Powell is back in action today, giving the markets a classical rug pull. Now, the Fed dot plot is quite disgusting, and the Powell press conference really didn't give us all too much. So, we have a deep dive on what happened today with Fed Jerome Powell, how this could affect the markets, as well as stocks such as Tesla. So, let's get into it, ladies and gentlemen. Hit the like button and subscribe to the channel and source your comments, questions, or concerns down below in the comments section. If you like to make money, if you want to grow your net worth, if you want to stay up to date with everything happening in this market, and you want to reach financial freedom, this is your place to be. Now, as you can see, heading into the close of the day, the markets are virtually unchanged. There was a big drop upon this initial report in which you really didn't rally until Fed Jerome Powell started to speak. And the bottom line conclusion, summary of economic projections, very negative. Fed Jerome Powell in his speech, pretty dovish, pretty bullish. So let's get into exactly what was said in the ugly, the economic projections. So this is where the rug pull really comes into play, because a rug pull, I like to define it as something that is unexpected by the markets. And that's exactly what we got. So the terminal rate at the last summary of economic projections was 5.1%. The new terminal rate is 5.6%, meaning the Fed projects to raise rates 2 more times. Markets were only expecting 1 more rate increase. But even on top of that, the 1 and 2 year interest rate projections, meaning where interest rates are going to be 1 or 2 years down the line, also went higher. The 1 year inflation projection, or interest rate projection, I should say, is 4.6%. The previous summary of economic projections was 4.3%. 2-year interest rate projections are at 3.4%. Previous summary of economic projections had us at 3.1%. So basically 2 more rate hikes in 2023, and to hold rates higher for longer is what you really got out of this statement. Now, on a positive note, which I think this is a positive for stocks such as Tesla, the GDP was revised much higher. So the March summary of economic projections, the Fed expected 2023 GDP at 0.4%. Well, now they're expecting GDP at 1%. They revised down GDP for 2024 from 1.2% to 1.1%. And they revised down slightly as well GDP for 2025 from 1.9% to 1.8%. So that's kind of the positive here. It looks like you're getting closer to a soft landing. At least that is what the Fed projections are telling you. The negative is a lot of stocks that have really carried this market, your big tech names, have been going higher in 2023 based off of this narrative that the Fed will cut rates soon. In fact, you got the opposite, and now we're expecting 2 more rate hikes instead of 2 months ago expecting 3 rate cuts in 2023. So expectations have drastically flipped sides here, and stocks have continued to go higher. And if they continue to go higher from here, the conclusion you would draw is the soft landing looks likely from here. Now, the unemployment rate, that also got revised down quite a bit. The unemployment rate in the March summary of economic projections was 4.5% by the end of 2023. It got revised down in this SEP to 4.1%, signaling again less potential stress in the labor market. And basically same thing for 2024 and 2025. In the March report, they were expecting 4.6% for 2024 and 2025, and brought down both of these to 4.5% for, again, 2024 and 2025. PCE inflation, this got revised down a little bit in 2023, remained unchanged for 2024 and 2025. The March projection was 3.3%. for the end of 2023. That got revised down to 3.2%. 2024, previous 2.5% remains at 2.5%. And for 2025, 2.1%. And again, remaining at 2.1%. So the actual report, the summary of economic projections, was pretty negative. Nobody expected 2 more rate hikes, or at least the percentage of people that expected that was very low. And that's why you can justifiably say this was a rug pull. Now, Jerome Powell made some interesting statements during the actual press conference, and that's what kind of made the markets rally higher. One of the most bearish things he said was that rate cuts are a couple of years out, but then he declines to call the June decision a skip, implying that potentially there might not be any more rate hikes. Again, pointing to they are data dependent. If they start to see inflation meaningfully coming down, then they won't have to do too much more. And Fed Jerome Powell did, as I expected, pointed out that headline inflation has come down quite a bit, but PCE is still 5.5% or 5.3% at the last CPI report that we just got yesterday, reiterating that you haven't seen much progress on your core inflation metrics, in which the Fed doesn't care too much about those headline numbers. So in typical economics, higher interest rates should mean lower stock valuations. That is not what we have seen in 2023, where earnings have actually been declining year over year on the S&P. But stocks are at their most expensive level that you have seen since 2021. And if this rally continues, could become more expensive than what we've seen when interest rates were 0. So I think when you try to boil this down and actually draw a conclusion here, I think it means you need to see more downside for stocks. But I think you get that downside if earnings come down, because if earnings come down, then you're really overvalued. You're just overvalued right now. If earnings come down, then you're super overvalued, and that's where you can get a fall. Now, in the near term, since the markets have rallied so much, so aggressively, so quickly, you could get some downside here. Stocks today actually closed in the green for the S&P 500, and this drop that we seen was quite substantial. You were green by about 0.3% before this report, and then you fell down 0.7% at the low and recovered all of it. Now, specifically when it comes down to Tesla, is the rally over? Is it going to continue? Well, Tesla's green streak is now officially over, as long as this move in after hours is not higher than 0.91%, the equivalent that Tesla fell today. So Tesla was in fact in the red. Tesla was in the green for parts of the day today, but it closed red. Now, I think specifically with Tesla, if you want to try to see through the noise here, you got to ask yourself this question. And I think this helps to explain what Tesla is going to do next. Would you rather have a better economy or lower interest rates? Meaning, would you rather have higher interest rates and a better economy, or lower interest rates and a worse economy? I would take higher interest rates and a better economy all day long. So with that thinking, I don't think the Fed signaling possibly 2 more rate hikes to come means that stocks such as Tesla have to come down significantly. I think this might have actually been a positive thing for Tesla, all things considered. Now, Tesla is obviously going to trade off of news and catalysts, especially since you have been on this rally. I have been arguing this whole time that Tesla really should have never been in the $100 ranges. So this rally really hasn't been that crazy if you consider where Tesla should have been. Shoulda, coulda, woulda. The stock was at $100. Yeah, so it's been a very strong rally from the lows. But when you consider this new information and the positive news that we have seen as of the last couple of weeks, I think the move to 300 and above 300 is more likely now that we do have this Fed meeting out of the way. But again, Tesla is going to react around news and catalyst. The biggest news that we got today was that France is basically begging Elon Musk to build his next gigafactory in France. And this is probably something that's going to be highly incentivized. France probably wants to make a pretty sweet deal for Tesla. So it wouldn't surprise me if we get some bit of news on the next gigafactory coming out shortly. And I think that will ultimately be a positive thing for Tesla. Now, Tesla's next biggest catalyst is going to be delivery numbers. And we're going to be getting those around July 2nd. Now, analysts' expectations are for Tesla to have delivered around 440,000 Teslas in Q2. If Tesla comes in higher than this number, you could be in for an even larger rally. If it comes in lower, then obviously there could be some pain. Now, we've gotten preliminary data from some of the delivery numbers with Tesla, especially out of China. And just in the month of May, Tesla confirmed sold 77,000 Teslas. So if you annualize that number, that's almost 300,000 vehicles alone that were sold in Tesla, if you consider the same strength for April, May, as well as June. So odds are we're going to get a beat to this number coming July 2nd. And then Tesla's going to react very positively. Now, if we take a look at the option activity, this can give us some kind of inclination how hedge funds and institutions are feeling, the players with big money. And if we take a look at today, you've seen 450 institutional orders for Tesla, and these are only options, keep that in mind, worth $621.6 million with a positive order value of 67%. Considering Tesla stock was red by about 1% today, you're not seeing a lot of bearish option activity for Tesla, and that is a positive. Now, in terms of a short squeeze as well, if Tesla does defy kind of your typical market expectations, which would be higher interest rates signaled from the Fed, lower valuations for automakers, and Tesla unfortunately is an automaker, or it's grouped in that category, I should say, then you could start to see a short squeeze. Now, the dollar amount that's currently sold short in Tesla stock is up 54% in the last 3 months. A lot of this is direct losses for short sellers, amounting to over $10 billion with this latest Tesla rally. Currently, you got $23.64 billion worth of Tesla shorts. And at this point, Tesla, even if we take a look at the move intraday, bounced right off of 250. Actually bounced at $250.50 per share, bounced with a very aggressive rally. So I think at this point, even trading algorithms might start to buy the stock around 250 if you do get that downside move. In fact, you want to see sideways trading or a slight down move to get the RSI to come down. Tesla stock yesterday was the most technically overbought stock on the NASDAQ per the RSI. Now you can see the RSI is right here. Even this 1% down move brought the RSI from about 91 down to 86. So you don't have to see a lot of downside to get a correction in the RSI. You just need to trade sideways or slightly down for a few days. Take NVIDIA for an example, and that down move in the RSI gives you more room to rally to the upside. Take NVIDIA for an example. NVIDIA is hitting a new all-time high today, $431 here in after hours. NVIDIA was at one point the most overbought stock on the NASDAQ. Well, NVIDIA traded down from 420 down to 375. If you take a look at the percentage that was about a 8.5% drop. And look, now Tesla's rallying to all-time highs, and the RSI is not even close to as overbought as it was back here. So it can give you more room to rally. I'm expecting sideways trading, some volatile up and down trading to get the RSI to come down before we do make that move ultimately to 300 and higher after July 2nd, the next big catalyst for Tesla. Now, last thing that I do want to go ahead and do is take a look at the data that's going to be coming out throughout the rest of this week. So what we're going to have tomorrow is retail sales month over month for the month of May. You were expecting this to be negative 0.1%. Last month's reading was positive 0.4%. Keep in mind what the Fed expects. The Fed expects better GDP now than what they did back in March. They expect 1% GDP growth now. They only expected 0.4% GDP growth. Well, if retail sales comes in way negative, then that might push back on some of that soft landing thesis. You're also going to have Philly Fed prices paid, business conditions, Philly Fed employment, import prices, export prices, retail sales year over year, your initial jobless claims. You're going to have a lot of data coming out tomorrow morning. Retail sales probably going to be the most significant data point, and that is at 8:30 in the morning. And then on Friday, you're going to have Michigan consumer sentiment for June. You're expecting that at 60. The previous reading was 59.2. So you're expecting consumer sentiment to get better by a little bit. You really want to watch the 5-year inflation expectations and the 1-year inflation expectations. The 5-year inflation expectations have been moving higher recently, and you are at the highest 5-year inflation expectations than you have seen in the last 10 years. And if inflation expectations go to 3.4%, from where they are now at 3.1%, you're going to be at the highest 5-year inflation expectations in the last 25 years. And even Fed Jerome Powell said today, inflation expectations have remained well anchored. Well, if they start to get unanchored, that could potentially mean more hikes than 2. So some key data points that you want to watch throughout the rest of this week. Ladies and gentlemen, that is going to do it for this video. Hit the like button and subscribe to the channel, and source your comments, questions, or concerns down below in the comment section. You guys have a great rest of your day, and I will see you in the next one.